135.47. What's the significance of this level? This level, guys. I did talk about throughout Friday's session, and indeed we were trading the break of it. This was the low of the year. This was the low of the year prior to that sell-off that we had on Friday. So large downside for the euro against the dollar. Euro weakness really generally across the board Friday. And therefore we drove down through and below 135.47, making a new low for the year. A little bit of a level here also, not as good as that 9th of January level, but here on the 3rd of December, 135.25. Also we went down and tested and really then the market found support and stabilized into the close. But look what's happening here now this morning. A little bit of upside here, a little bit of a rebound. We're now testing this January the 9th low from underneath now, so 135.47. So this is a good resistance level using that previous low of the year as a reference point. Now we were talking about the euro dollar at length on Friday because of what happened with regards to this very long-term trend line. So this upward trend line had been in place for 5-6 months here. You go back to the start of July, you take the reference point here, the low in November, and then throughout the last week we've been consistently finding support bang on this trend line. 5 days out of 7 this market found support on the trend line until finally it gave way on Friday, and this led to a pretty decent and fairly large technical breach that led to that move to post down, new lows for the year and indeed new lows since November. So we're just getting a little bit of a rebound here now, testing that from underneath that. So be aware of that technical level. But let's talk macro stuff. Let me just take my screenshot off here. I'm going to post the chart of the S&P. So I want to just talk about some. Actually, before I do that, let me post a chart of Chinese GDP. Although, unfortunately, this chart is wrong, hasn't quite been updated correctly by Trading Economics, unfortunately. But the big news over the weekend, well, not over the weekend, overnight, during the Asian session, was from China with regards to their GDP figures for Q4, and their GDP came in at 7.7% for Q4. This was a touch above expectation, which was for 7.6%. But if you look at 2013 as a whole then, well, the Chinese economy grew at 7.7% for the entire year. Okay, so that's basically the same as the year before. And again, this is the lowest annual growth rate since 1990, matching last year's new record. In 1990, the reason for the dramatically low GDP, and let me see if I can go back to 1990 on this chart. Hang on a second. No, it looks like 95 is the earliest I can get back to, unfortunately. But in 1990, we had a lot of international sanctions against China following the Tiananmen Square massacre, and that resulted in significant economic underperformance in that year. Since then, I mean, I know we've had dips, below where we are now, which is just shy of 8%. We've dipped down to 6% in the crisis here in 2009. We dipped down to that point during the Asian crisis in coming into the year 2000 in the end, I guess. We dipped down there to 6% again. But on an annualized basis, it's always been higher than what we posted for the last 2 years of 7.7%. But this is, this is expected. China are trying to engineer a slowing down of their growth rate to make it more sustainable. It's been fueled on unsustainable factors, and particularly government direct investment into infrastructure, for example. And they've got overcapacity now, and there's a little bit of there's debt concerns, particularly within the shadow banking system, and with the Chinese government's, or the new government who got issued into power last year. This is probably one of their biggest challenges. It's to try and alter the reasons that drive Chinese growth. And to make them now more sustainable, we need to see a switch more to the services side of things as this economy matures. We cannot see China continue to drive their growth through government infrastructure spending. We have an overcapacity. So this is a long road to try and transition to a more sustainable growth basis, but you know, they're doing it. It's happening. There's certainly a lot of risks ahead, but so far so good. A growth rate of 7.7% is absolutely fine. If you'd have asked economists 12 months ago, would you accept a growth rate of 7.7% in China for 2013, you'd have absolutely had your hands snapped off. 12 months ago, we were worried that Chinese growth would drop below 7% and we would get the so-called Chinese hard landing, and that this would have a very negative impact for the global economy. So 7.7%, looking back overall, is actually a decent result. And going into 2014, can we see China's growth rate transition? And what will help it, all things being well, the developed world in 2014 should see a return to something more like long-term growth rates, and so we should see the developed world increase their demand for products from China, which should help with this transitioning process and just get them off this government direct investment drug that they've been on for the last few years. So a decent result from China, you would say. I'm just going to post the S&P chart actually, because it is the European banks that have caused a little bit of a problem this morning, and that's why we've got a little bit of downside here off the bat for the equity indices generally. But just talking about China further, it wasn't just GDP figures that got announced last night. Also, industrial production was 9.7% for December 2013 compared to December 2012. We had expected 9.8%. Retail sales were in line, plus 13.6% year-on-year growth. The People's Bank of China said that cash demand is to increase substantially before the Lunar New Year holiday, and has asked banks to tame the pace of lending. This is the China news. This euro dollar has just ticked up through that key technical level I was talking about, guys. A little bit of activity there. See a few stops perhaps getting triggered, so just be aware of that technical situation. But looking at this S&P, you know, it's quite interesting in the end. Friday evening, we've got some pretty heavy downside. The market stocks, well, let me just zoom in on Friday's session. Let's just go back, because it was a fairly interesting day. They're really bullish to begin with, and the S&P drove up and basically tested its all-time high as well on Friday morning. As the DAX was making an all-time high, the S&P pretty much got up there. It's just a few ticks off. Actually, let me just check that on my daily chart. Yeah, it was 4 ticks off, I think, wasn't it? 3 ticks. So we're 3 ticks off that December 31st high, the all-time high. Let me just go back to the 10-minute space. So, but as soon as we topped out there, we stabilized, and then it's actually a fairly negative session. We went through the day, quite a big sell-off here just after the US cash open, and then a nice strong rebound. It was quite a tricky session at times for stocks, and then in the end, it wasn't until right into the close that finally the support levels gave way, and this market actually drove lower. If we go to the daily chart, it wasn't particularly anything dramatic. I mean, as weeks go, last week was fairly extraordinary, and actually we closed pretty much where we started. So on the Monday, the S&P started at 1838. We then had the biggest sell-off for, I think it was 3-4 months, selling off 1.24%, hitting this very important support level at 1812.50, reversing on the Tuesday, literally the following day, reversing the vast majority of that massive sell-off, adding to those gains on the Wednesday to almost test the all-time high. And then things settled into the end of the week. But actually we closed pretty much where we started. Now be aware of this range for this week. Remember, we were talking about this at the start of last week, this ultimate range we've been in this year, and really since the 20th of December, has been this, well, what is it? It's a 34-point range, and so we may well find ourselves drift down towards the bottom side of that again this week. So it's a US bank holiday today. Bear this in mind.